At the end of November, the USDA will update its forecast for 2016 U.S. net farm income. The current forecast of $71.5 billion is more than 42% lower than the record farmers and ranchers set only 3 years ago. As producers go through the tax planning season, Tina Barrett from Nebraska Farm Business, Inc. says that slide could now be more noticeable. We talked with Tina recently and started by talking about how this year might be different.
Well, I think this is going to be the first year that we're really seeing some of those accrual net farm incomes drop off, which means people are going to feel like they haven't made a lot of money. And I think it's really important that we don't forget tax planning in a year when it's low, because it can almost be more important than when it's high income time.
You want to go a little bit more on why cash might be low, but perhaps you've already spent some?
Sure. So there's a couple big things. The big issues of taxable income might still be high even though you don't have any cash left would be family living, because it's not deductible, and principal payments, which are not deductible. So we know family living's been on the rise. Haven't seen a whole lot of decline in that, so we have that issue. Second issue being principal payments. We know that we used 179 a lot in the last 5 to 7 years, and a lot of those purchases were financed, which means we're making principal payments today, and we took all that depreciation expense in years past. So we're giving up cash for those two big non-deductible items. And so we might be looking at an operating note that's maxed out, but still have high taxable income.
If that income is low, how does that affect your tax planning?
So, it's been a while since we've had to think about these strategies of how to increase income rather than decrease income. But, there's things that sometimes we maybe just need to get a little bit out of our comfort zone again. And if you're used to deferring all your grain sales, maybe, making some plans now to start recognizing some of that income in this year. Again, getting that deferred income back into a current position. That's the whole point of what we did for the last 5 years of building those inventories. Now we got to reduce those. We may be looking at whether or not prepaids make sense, and is that discount good enough to offset the tax savings. And that's such an individual decision, so it's something that's real important to discuss with your tax advisor.
For people that might not be familiar with the tax planning of an agricultural operation, can you explain why even in years of very low profit margins, you're still not talking about losses here?
Yeah, and the whole goal usually with tax planning is to even that cash basis income out. So we don't pay the high rates in the high income years, and we don't see big dips in the low income years, because there's things like our standard deduction and personal exemptions that if we experience a loss and create a net operating loss, we don't get those things back. If we create a loss on Schedule F, which is where the farm income is reported, we may be having income that we could have received free from self-employment taxes in this year that we might have to pay on the next year. So it becomes a timing thing. In the way the tax laws work, we don't always get the same benefit by carrying back or using income averaging or any of those kinds of things. So it's important that we might manage those things.
Any other changes for this year that producers need to be aware of?
There's not a whole lot of things. We had that major bill be extended. We do have some deadline changes for this next coming year, so just to be aware. And most tax preparers are going to be on top of it, but C corporations that were due March 15th are going to be moved back to April 15th, and partnership returns that were due April 15th are being moved to March 15th, just so that we get those information reporting returns done in time for individuals to get theirs done. So that's the big change so far. Of course, we've got a long time to go before filing season.
For people that might have a low income number, what can you do to try and increase that?
We talked a little bit about bringing some income in. There's other things, maybe if we're not willing to let go of that grain, because that's, I think, another issue this year is that we're not really wanting to let go of that grain at these prices. We may be looking at using CCC loans as a way to generate some taxable income without letting go of that grain. We may be looking at, there's some other options with deferred price contracts that we maybe can use to do some things. So it's really important that we look at some of those kinds of options. There's also some non-farm things for those producers who put a lot of money into traditional IRAs in the last few years. Maybe we look at rolling that into a Roth so that we got that deduction in those high income years. If we got losses, we could potentially recognize that at zero tax, let it grow tax-free from here on out. So again, lots and lots of things that we can do. We just need to get you into that tax repair so we can get it done.
You can learn more about tax planning through Tina's recent Crop Watch article. Tina will also discuss the outlook for farm finances during the Market Journal Roadshow in November and December. You can find information about those meetings by visiting mj.unl.edu/roadshow.